Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Today, we're going to be talking about why Saylor has already won the game, why strategy is inevitable, and we're going to be talking a lot about dividends and risk. There's a whole lot of talk about risk out there, how strategy is going to pay the dividends. In addition to the ATM guidance, there's a lot going on, but I want to talk about why I believe how they're going to pay the dividends is such a minuscule issue, and it's really missing the forest from the trees in the dialogue about strategy. In my humble opinion, of course, remember, this is not financial advice. This is financial entertainment. Let's get started. So here's the only question that actually matters, okay? This is what backs the entire strategy thesis. It is the Bitcoin growth question. What happens if Bitcoin keeps compounding at 30% a year for the next decade? Legacy finance wants to talk about quarterly earnings per share and same-store sales, but none of that survives contact with exponential math. So these are the inputs. Strategy already has 630,000 Bitcoin, and let's say conservatively they add 50,000 every single year. I know, extremely conservative, but that's the point. You're going to see the power of the balance sheet that they already have. With Bitcoin at 117K right now and Bitcoin growing at a 30% compound annual growth rate, we're going to see where this goes over the next decade. A lot of people say, Adam, what about the 30% compound annual growth rate? Is that kind of pie in the sky? No, it's not. It's actually a lot higher over the last decade. Everybody agrees that the compound annual growth rate for Bitcoin is going to go down over the next 10 years. But in my opinion, 30% is actually a pretty conservative estimate. If you want to put in 20% or 40%, have at it. All the numbers are going to be great. So a bit of a spoiler, if they add 50,000 Bitcoin to today's balance sheet, they're going to end up with about a $103 billion net asset value. After year 5, that's going to compound to $400 billion. And after year 10, that's going to be $1.8 trillion, starting with the balance sheet they have now, only adding 50,000 coins a year. That's without leverage, that's without derivatives, that's without any carnival tricks that Wall Street uses to juice numbers, that's without any more carnival tricks that Michael Saylor has up his sleeve. This is just the compounding collateral on autopilot based on what they already have for the next decade. So the so-called Bitcoin growth question is really a trick question because once you see the curve, you realize it's not a question at all, it's a verdict. If Bitcoin compounds, strategy eats the world. If it doesn't, the whole global system is already toast. Because remember, Bitcoin is just the scoreboard for fiat debasement. So this is where things get a bit obscene. This is the 10-year Bitcoin net asset value projection of Strategy's balance sheet. Remember, let's say they end up this year with 680,000 Bitcoin, ending the year with a net asset value of $103 billion. You can pause the video if you want. Obviously you can see the numbers start to get crazy. That's the power of compounding, folks. But after year 5, 382 bill. And at year 10, you're going to see, given the inputs, that strategy will have 1.13 million Bitcoin on the balance sheet, a Bitcoin price of 1.6 mil, and the net asset value at $1.82 trillion. So remember, this is not theoretical cash flows from some business with a lot of physical risk in the world, given their operational drag. This is literally the hard collateral on chain today, compounding like a virus in the bloodstream of the global financial system. So I wonder if Wall Street analysts are still going to be in Excel looking at price to earnings on companies trading at a 300 PE, while Strategy's balance sheet quietly 18x's itself on money that it already has. So when people ask what's the upside for strategy, the answer is very simple. You're looking at it. The upside is that this chart becomes reality and every other company still arguing over stock buybacks and dividend payments is already dead, but they just haven't filed the paperwork yet. So now let's talk about Strategy's big scary burden, the preferred dividends. They've issued 4 flavors of preferred: Strife, Stretch, Strike, and Stride. Together, right now, they owe about $585 million per year in dividend payments. That sounds like a monster number until you realize that their net asset value increases by tens of billions annually. So if 1 year alone the Bitcoin stack grows $40 billion, that's 70x the coupon load. By year 3, the delta covers it by almost 100x, so the coupon isn't a burden, it's lint in the dryer trap. You also have to remember the current plan is to let the convertible bonds equitize. So there's going to be a much cleaner balance sheet. Obviously, Michael Saylor could cook up some other preferred instruments, to issue more debt. They could increase the offerings of the ones that already exist. But the fact of the matter is, dividends are not going to be a problem. So after year 1, the dividends are 0.57% of the net asset value. After year 5, that reduces by 1/4 to 0.15% of the net asset value. And after 10 years, 0.03%. That's the value of the dividends they're currently paying on the price of Bitcoin, the price of the net asset value on their balance sheet in 10 years. After a decade, the coupon is literally a rounding error so small it barely shows up on my slide here. So the truth is simple. If there's this big of a spread between the compound annual growth rate, the Bitcoin stack growing every single year in perpetuity, and the dividend burden growing so slower compared to that, every single year the coupon that strategy owns is just going to shrink into irrelevance until it's basically the financial equivalent of a mosquito landing on a freight train. I'm sorry, in my opinion, if you still think that $585 million is risk, you're living in a fantasy. The real risk is owning companies that pretend to be solvent by paying their dividends out of debt. So Strategy's burden is going to shrink to dust while its balance sheet becomes a planetary object. That's not risk, that's inevitability. So let's talk about America's favorite dividend machine, McDonald's. They pay a 2.25% dividend yield. You know, we love that. They have a $224 billion market cap. All the analysts chanting that familiar chorus, safe, reliable, cash flowing. But if you peel back the wrapper, do you know what you find? Negative $3.5 billion in equity. That's right. Liabilities bigger than assets. The clown owes more than he owns. So what are investors really buying at an almost 27 PE ratio? They're buying the promise of future burgers, 27 years worth of them. They're buying smooth dividends funded on top of a hollowed out balance sheet. And the world has no issue with thinking that this is safe. This is the insanity of modern finance and why risk in the market is currently mispriced and misunderstood. McDonald's has literally become a bond proxy with French fries. If your company has a negative net worth that's showering investors with dividends to keep the illusion going, what do you think this whole game is? If you contrast that with Strategy, backed by an appreciating hard asset that they already have, that is fundamentally scarce, they can't make more of, already compounding into the trillions of dollars, yet they're punished because the Bitcoin price chart wiggles? This is not risk pricing, this is psychogenic illness. So this is the takeaway. McDonald's is the illusion of stability, and so are all these other legacy traditional companies that we all grew up with. Bitcoin treasury companies are shattering the illusion of safety. You have to think about why you would own stock in a company in the first place, right? In my opinion, it's to grow shareholder value. So why do people continue to get this idea in their head that it totally matters which way your value appreciates? If one method is appreciation of the assets, a huge percentage in perpetuity into the future, and the company can afford debt, endlessly raise capital into the future to just buy more, something you can't do yourself, how does that not command a multiple, but McDonald's does? I'm sorry, I just think it's insanity. I don't get it. Maybe I'm the crazy one. I don't think I am. I guess the next decade will tell. I just think that one is safe, but nobody thinks it is, and then the other one everybody perceives as safe, but it's literally hollow on the inside. If McDonald's is a Happy Meal, Strategy is a neutron star, which one do you want to be holding when the entire system resets? And I'm going to put the Strategy snapshot here for you so you can look at the numbers yourself, but this is just illustrating the inversion of modern finance. The market pays for smooth but fragile illusions and discounts the messy but inevitable compounding machine. So with McDonald's, a $220 billion company with all of that operational risk, look at this, they're paying out a 2.2% yield while they're technically insolvent. And then you have this company Strategy paying out 9-10% yields, but it's against a treasury base that's going to grow faster than any liability. Investors are buying into an inevitable black hole. You also have to remember that the higher the net asset value, the more debt can be issued. That means the more Bitcoin Michael Saylor is going to buy. The faster that he grows his stack, the faster he's going to be able to afford more financing, raise more capital to buy more Bitcoin. It is the reflexive loop that's going to keep on growing. And remember, everything I've stated here is a conservative estimation. Wall Street continues to hallucinate price to earnings that do not make sense in the slightest. But Strategy doesn't need to hallucinate anything because it already has the collateral. It already has the math. If Strategy went to a 1.1 multiple of the net asset value and they never bought another Bitcoin, it would still be an obvious buy to me. You either get inside the machine or you're going to get crushed by it. So this is the math that Wall Street refuses to process. The aggregate cost of Strategy's preferred stack is about 9.16%. That's the coupon that they pay for fiat capital. On the other side, Bitcoin compounds 30% per year. That is a 20.8% spread accruing straight to the common equity. Think about that. Every dollar borrowed at 9% is being recycled into an asset compounding at 30%. That's not risk. That is legalized capital arbitrage. Just after 2 years, that net asset value accretion is going to dwarf the coupon, a coverage of 96x. By year 10, the coupon is literally 0.03% of the NAV. It's going to vanish into irrelevance. This is the ultimate market mispricing. The world rewards clown dividends funded by debt while punishing the one company that turns fiat liabilities into a compounding black hole. So this is where psychology does more damage than math ever could. Risk isn't actually mispriced because the numbers are hard. It's mispriced because the market is full of people trained to mistake smooth lines for safety. You have to think about the accounting optics. McDonald's uses buybacks to drive book equity negative. That's fragility disguised as shareholder friendly. The market eats it up because the dividend looks tidy. And when it comes to volatility, portfolio managers are conditioned like Pavlov's dogs. They see a wiggly Bitcoin chart and scream risk, but they see a flat dividend line and scream safe. Never mind one as collateral compounding at 30%. There's also benchmark constraints too. Funds are forced to own McDonald's by index mandates, but right now Strategy, off limits for most. As of now, of course, as of now. So that's structural demand subsidizing absolute clown world multiples for burger bonds while suppressing a balance sheet singularity. There's also narrative inertia. The burgers pay dividends is a 40-year bedtime story. Bitcoin balance sheets compounding is new, and I think that markets lag regime shifts until they look too obvious, but then it's too late. Now lies the opportunity. And I'm sorry, but dividend equities at 25x to 30x earnings are just bond proxies with ketchup packets. And they're the ketchup packets that you have to ask for from behind the counter now. You can't even get them yourself. Raise the discount rate, terminal value implodes. So why is risk mispriced? Because Wall Street doesn't measure solvency, it measures feelings. It prices vibes, not math. Which is why a clown show with a negative equity gets a premium multiple while a company compounding into trillions gets labeled risky. That's not valuation, that is psychosis. Let's end by redefining risk because the market's version is clearly clown world nonsense. There's business risk. McDonald's sells burgers, low to moderate risk, I guess, until you realize it's competing against Ozempic and a generation that DoorDash's lettuce. Strategy, the business is literally holding Bitcoin. It doesn't rot. It doesn't unionize. It doesn't demand healthcare. That's very low risk. There's also a financing risk. With McDonald's, that's a bit elevated. Negative equity, debt-funded buybacks, addicted to rolling credit markets, one rate shock away from finding out what insolvency tastes like. Strategy fixed coupon covered by 70x in year 1 and nearly 100x in year 3. That's not fragility, that is structural over-collateralization. And then there's a valuation risk. McDonald's, hi, you're paying 27 years of earnings upfront for a liability-driven brand, and Strategy trading at a 1.5x MNAV backed by collateral compounding at 30% a year. So here is the clean taxonomy in my humble opinion. McDonald's is just fragile. It's disguised as stability. People see that as stable, which is literally just insane to me. One asks you to prepay for decades of future burgers on negative equity, but the other hands you present collateral, money that they already have, with exponential optionality. The markets call the clown safe and the black hole risky, but the truth is obvious. The clown dies with his dividend and the black hole eats the galaxy. And you have to decide which end of the inevitability you want to stand on. Thank you so much for watching. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like the video, subscribe to the channel, and help me spread the orange pill to the masses. Have a terrific day, folks. Class dismissed.